Over the last 10 years, we've been building a specialist asset management business, and indeed nearly 5 years of that has been on AIM, and we've now grown it from 30 million in funds under management to over £500 million in that time. And we do that through the combination of balance sheet capital, balance sheet investment capital, proprietary capital, alongside third-party equity and debt funds to provide superior returns, not just for fund investors, but also for shareholders. And we have been achieving this and doing this through our focus on the UK regions, sourcing deal flow in the UK regions and combining that with operational insight and investment expertise. We stood up just recently and put out a statement of what we intend to achieve over the next 2 to 3 years, which is continue to scale and build momentum within the business. And what that means is grow funds under management to create a profitable asset management business that in addition benefits from strong cash returns from our balance sheet investment activity. This model is quite important to spend just a couple of minutes on it in terms of really what is at the heart of our hybrid investment model and a real differentiator for what Mercia does in the market. So on the very left-hand side there, that's our deal flow sourcing. We have 19 university partners across the UK regions, and they account for about 20% of all the deal flows that we see. This year, so in the financial year that's just gone past us, we saw something like 3,000 requests for investment, and that's up from 1,800 the year before. And into the lighter blue portion there, which is our third-party funds that I talked about, we have £380 million worth of third-party funds in those. We made investments into 150 companies in that 12-month period, and that's up from 90 the year before. So the business is growing in terms of its investment activity as well as its funds under management. And then our proprietary capital, our own balance sheet investment, then invests selectively into those businesses. We've got 400 companies within that portfolio of third-party funds, and we brought 2 of those across onto the balance sheet. So 3,000 requests for investment, 150 companies come onto the third-party funds, and 2 of those come across onto the balance sheet. Now, those companies may spend 6 months, 12 months, 6 or 7 years within the third-party funds as we build those businesses, build the models and build the revenue generation of those businesses. And then we selectively bring them across onto the balance sheet when we have a strong and reasoned perspective that they'll be converted back into cash in a 3 to 7 year period. So that balance sheet capital there is to scale the revenue basis of the business. A majority of our businesses that we're investing into are revenue growth stories. This table breaks down the asset classes that we occupy. On the left-hand side, those 3 light blue columns are our third-party funds: venture, private equity, and debt. And then the balance sheet is our proprietary capital. So if you read through that top line, what you have is 380 million of funds under management through those third-party funds, and then 126 million in a net asset value, which is cash and investments on the balance sheet, which gives you just over £500 million there. But as I said, we've been building this for over 10 years. So we've been on AIM 4.5 years, and you can see from the dates that we've been investing capital how long we've been in the regional markets. And we are a regional investor. We're sourcing our deals from the UK regions. We only invest domestically in the UK. Underneath that, you'll see the returns. And the returns aren't just from the debt, the private equity, they're from across the whole piece, all the way across to the balance sheet. So as I said, when we're making those investments, we expect over a 3 to 7 year period those things to be coming back as cash. We've had 3 full cash returns now on our balance sheet: Abzena, Alinea, Science Warehouse, full cash back onto the balance sheet for reinvestment purposes. And then importantly, the final bottom line is the cash that we have to invest. The fund manager is only as good as the cash on hand it has to go forwards. Across our funds, we have something like 170 million of free cash to invest over the next 3 to 5 years. These funds are typically 10-year funds, and a majority of the funds that we have under management are 2 to 3 years into their life. So we have a steady stream of capital coming through and a steady stream of fund management fee coming back from managing those funds. And then on the balance sheet, as of the 31st of March, so these are from our prelims, we have £30 million of cash on hand. That's £200 million dedicated to the UK regions and dedicated to Mercia's investment activity over the coming period. So this is a group that is well cashed up for its investments going forwards, not just to support existing portfolio, but to add new businesses as we continue to build momentum within the group. And we are very focused. We have a very clear marked out market that we focus on, which is the UK regions. We go across venture, private equity and debt within those regions, and our balance sheet capital is reserved exclusively to invest in the funds that we manage and to invest in the portfolio that comes out of those funds. We have 21 companies on our balance sheet. All of them have come through the funds. We have got to know them in the funds before they come onto the balance sheet. We only invest in businesses that we understand, that we have operational and technical experience within that area. And importantly, we go into very, very modest capital need businesses. So we look at whether a business will require more than 10 million across the group, so from our funds onto our balance sheet. And if it will, it's not for us. This is a world where you have cycles, where things come in favour and out of favour. If you cannot support those portfolio companies, you will lose them. Somebody else might benefit from them, but not you. You need to have businesses where your own resources can support them in good times and bad. And that market, when you look at published stats, the British Venture Capital Association has this published annually, you can see the size of it, and that's a 1.3. So last year, 2018, 1.3 billion was invested across that market. That is a sizable, growing and a fully addressable market to the Mercia model for us to continue to scale and build within. But why focus on the regions? Certainly when Martin and I brought Mercia out into the IPO back in December, that was a common question. Why the regions? Last year, that blue dot there, that's not the southeast, that's London. So 45% of all equity investment last year was just in London. And the rest, those smaller blue dots across the regions, is where the rest of the investment was deployed. Indeed, just recently a report came out that showed Q1, Q2 for 2019, 74% of all venture capital deployed was deployed in London. Yeah? So that's resulting in a great place if you're a company looking for money. You can command great pre-money valuations if you're in London at the moment, because there is a huge oversupply of capital. We don't go there. We go in the regions, because what's interesting, the high growth firms, what we're all looking for within private equity and venture, those businesses that are growing over 20% year on year on year, only 20% of those are in London. So maybe half the capital is going to London, but actually a majority of those high growth funds are across the regions. And that's where we're based. We have 8 offices across the regions. Our 19 university partnerships, which count for about 20% of our deal flow, are in the regions. We've got 86 employees who are out there in the regions unearthing that deal flow. The intermediary community within the regions is nowhere near as advanced and as developed in London because of the oversupply of capital that's there to service it. So you have to go and get that deal flow. You need the people out there. You need the physical presence there. The beauty of that model is it's off-market deals. You are very rarely in competition with others. It's off-market. Therefore, the entry price to those deals is optimum for the investor and arguably for the investee as well. So right back to December 2014, we had 2 clear statements of intent that we put out there. One of them was to prove this investment model, this hybrid investment model of combining managed funds with balance sheet activity that can deliver value both to fund investors and to shareholders. And the second one was that there is regional value. You can find good deals in the regions, but you can exit. You can cash exit from those regional deals as well. Go forwards now, 96% of what we've invested in has been from outside of London. So a majority of our activity is outside of London. As I've said, we've grown assets under management from 30 million in less than 5 years to £500 million. And this is capital from experienced investors. So money is following us on this journey as well, which I think is a validation in itself of the model. That 1.3 billion market, we've taken about 6% of it so far per annum. We are now the 2nd most active investor in the regions, 4th most active investor nationally against some very high profile investors. And then we are making returns. So we're not just picking and making good deals, we're actually exiting from them. Some of you will be aware of Blue Prism. We were the founding investor in Blue Prism. We turned £900,000 into £95 million back to investors. Yeah, that was a young startup with 2 people in Liverpool. Great business. Alinea, a number of you may be aware of that. We had a number of private investors that came alongside us in Alinea. Coventry-based business in the Midlands, sold a full cash exit, 26 times to the fund, 21 times to the balance sheet. Again, that was a full cash return, a very, very good return for us. So standing forwards then, in July, at our prelims, we made a very clear statement of intent as to what we intend to do in the next 2 to 3 years. To move to being the #1 investor in the regions. We think that's eminently achievable. Aggressively grow assets under management, and predominantly here, funds under management, to £1 billion. So double it over the next 2 to 3 years. To take a larger share of the market and move up from 6%, and move the group towards a profitable trading basis. But this is through our fund management activity. Okay, so this is ahead of fair value gains on the balance sheet, realizations on the balance sheet, profit share, etc., etc. This is to do with a trading basis. But on those fair value movements, and importantly cash realizations, I said we've made 3 already, we will continue to make those. We intend to have evergreen the balance sheet. Once we've done that, we have built a sustainable investment business with a novel hybrid model that we believe is already delivering.
Good evening, everybody. When Mark and I were last here presenting, we were talking through our interim results for last year, and I'm just going to spend a couple of minutes now just talking through our full year results for the year to March 2019. Our revenues are growing well, as you can see here. This is being driven by our increasing funds under management, and the key for us to become a profitable business at what we call the net expenses line will be to drive those funds under management. Today they're just under 400 million, and we will be profitable by the time we get to 600 million. So our objective is to get to 1 billion, but we will be profitable at 600 million. Our cost base is growing as we've built out the team, but the good news about there is that the team is now built, and that includes both the front office from an investment perspective, but also all the back office functions that you need to run an asset management business. So as we drive in the future, as we drive our growth in funds under management, we will not have to increase the headcount proportionately. Our portfolio, which we'll talk about in a moment, is also progressing well, and that's indicated by the increase in the fair value movements that are now coming through. And these fair value movements are underpinned by third-party investors coming into those companies, and they are the ones who set the price of the next funding round, and therefore the value of our direct investments. So our full year results, we reported a statutory profit of 2.6 million. As you'll have seen from our previous presentations, there are really only 2 key numbers in our balance sheet. The 87.7 million, which is now the value of our portfolio, and as Mark mentioned earlier, the 30 million of cash that we still had left to invest at the end of March. And our net assets are 126 million. And that equates to 41.6 pence per share, which you can obviously compare with our current share price, and see that today's share price is significantly underpinned by what we would call hard assets. Our annualised investment run rate is about 20 million. It has been for the last, as you can see, for the last couple of years. This sort of bar chart just gives you a pictorial representation of how our investment portfolio on our balance sheet has developed over the last 4 to 5 years. So we started with just under 10 million of assets on the balance sheet, and we've grown it all the way up to, as I said, 87 million. Along the way, you can see a couple of years where we've had realisations. And as the portfolio matures, we will expect the number of realisations and the amount of cash being returned to grow. And likewise here, we're just representing the 4 asset categories that Mercia now manages. And you can see the percentages that each category represents of that 500 million of assets under management. And this is a table that many of you, I'm sure, will be familiar with. It's in our annual report and accounts. And this shows the development of the portfolio over the last 12 months. So the opening value on the 1st of April was 66 million. We invested 17.7 net, so it was 19 million gross. We did have 1.7 million of loans repaid by our portfolio companies during the year. The fair value movements I mentioned, you can see there. And what's important to note is that the number of companies that are reporting fair value increases is growing. And that's a good sign that the companies that we have brought across onto the balance sheet are the right ones. And at the end of the year, the portfolio, as I said, was worth 87.7 million. And as again, you'll have heard us say before, we look to build direct equity stakes of between 20 and 40% in those companies. And again, you can see there that by and large, that's where we are. Also important to us is portfolio risk management, and what we don't have is one investment that completely dominates the value of the portfolio. And here, our largest investment, which is by value, which is nDreams, is only 17% of the portfolio. And the good news, as Mark will talk about in a minute about nDreams, is that that's a very fast-growing business. I'll pass back to Mark.
Okay, thank you. So we've got 20 direct investments. We've actually got 21. We just added Clear Review to it. So we have 21 direct investments, and we are continually growing the number of direct investments. And they have high-profile commercial partnerships with them as well. So as I said before, these are businesses in revenue, strong revenue growth with credible commercial partners, very often a B2B focus. So very few of our businesses are B2C focused just because of the capital constraints and needs of those sorts of businesses. Just in terms of balance, and it's back to the sort of cycles within investments, we are very, very strictly kept to making sure that on a sector basis our balance sheet is not over-focused on one area, digital, life science, software, etc., nicely spread in that regard by value. And then in terms of stage, so the businesses that we've sold, 2 of the 3 actually were profitable businesses and moved out, and very much as our businesses go into revenue growth, they get more and more trade sale interest, and most of our exits will be through trade sales. We've got 8% of the portfolio profitable at the moment, 62%, so 70% of the portfolio are in strong revenue growth or profitable. We do have early stage businesses, but they are businesses that are just on the start of their journey into revenue growth. So just going through those 4 asset classes, direct investments, we invested 19.4 million into 17 companies. Put this in context, the group last year invested 75 million. But that's not 75 million coming off the balance sheet, that's 19.4 coming off the balance sheet. And that's an important differentiator of not using your proprietary capital for everything. 2 businesses that came across that we talked about before, Locate Bio, W2. Locate Bio is a medtech business. It's got a bone cement with a antibiotic delivery into it and is partnered with a partner which we can't disclose and has another program just going into the clinic. That actually has very modest capital needs. It's got revenue coming in from its commercial partner already. W2 Global is an AML, automated AML software platform working with the gaming industry predominantly and the gambling industry. Again, very strong multi-million pound revenue growth. Portfolio, balance sheet portfolio, performing at a 14% basis IRR. Our focus is to make sure the balance sheet and the funds are performing at 15% or more. But to put this again once more into context, our balance sheet is young. So you saw earlier about the funds. These funds are 10 years older, some of our legacy funds. The average holding age on our balance sheet at the moment is about 2.5 years. In fact, that 3 to 7 year period that we're holding them for, we expect that IRR to increase as those businesses go up. The first part of the journey, we are the sole provider of capital. And so there's no climb in value because we're building a position into it. 2 of our direct investments from there as examples are our top 2. Endreams, as Martin just mentioned, VR player, who has partnerships with all of these. We've made an announcement just recently about a significant partnership with Facebook Oculus, and they won E3 Games in July as a best VR game platform there. A business it's over 100% growing in revenue in that respect. Oxgene brings together robotics, software, and synthetic biology. When it came onto the balance sheet, it was turning over 500,000. Year before last, that was 1 million. Last year, 3 million. This year, it's going to do 5 to 6 million. That is growing very, very fast, and we're very pleased with that. Substantial equity stakes in these businesses. And then within our managed funds, first of all, we've got venture here. We invested in 61 companies. So remember, of that 150 companies, 61, again, was from venture, 30 million invested. New business, Invisius, Edinburgh University spin out, working in dialysis. It's got a protein coating that goes across there which prevents inflammation, predominantly a reaction and inflammation approach. Very, very strong business in the clinic with that. And as we are going to be announcing a significant syndication. But here it is. It's a business with significant syndication, strong growth in the clinic, but not yet ready to come onto the balance sheet. So all of that going on, but still not ready to come onto the balance sheet yet. Blue Prism we've talked about. I shan't talk about that any further. And this is our oldest venture fund. And those numbers are out of date now because we've just unwound that fund completely. So it's about a 16% IRR. I think it's 5.4 times money gone back to investors. So, and this was focused on early stage North of England businesses. You can make money from the regions. We are making money from the regions. Private equity, again, focused out in the regions. Park Via, so if you go online, you're booking to go to... People refer to airports now as car parks where plane visits, yeah? So you go to Park Via, that's where you get your car park booking from. So this is a growing fast business, as is Quick Reach, Powered Access. Profitable businesses. Our private equity investments are only into profitable businesses. And we put operational improvements in those to rapidly grow those and then sell them on. Again, one of our older funds is returned back about 2.5 times now money back to investors in that fund, 19% IRR. Debt, again, different team on this. We have a different team on our private equity, different team on the venture. Debt's performing very, very well. We've gone into 65 companies in the last 12 months with 15 million, typically writing cheques of sort of 200 to £500,000 into those businesses. Harrogate Springwater, a number of you may be familiar with that company. We've done multiple lends to that business. Very profitable business. And again, debt, we only lend to profitable businesses through our debt business. Again, Polymer Group, very, very profitable business. And again, fund returns. This is after our cost of management, etc., 107% gone back to the clients. So, in conclusion, it's not about a needle in a haystack. It's about picking a needle in another stack of needles. Okay? And I'm not being flippant here. For anybody here who's gone into venture, it's exactly what it's like. And time really helps you. So in the funds, time helps us decide which is the genuine needle that we want to bring across to the balance sheet. And once we bring them across to the balance sheet, or whether in the funds, it's about building value. We bring more than just cash to these businesses, which is why we see so many businesses. We bring value and grow the value in those businesses. But as we've said, fundamentally, for Mercia now, it's about growing funds under management. And the reason it's about growing funds under management is to take this business to a profitable trading basis within 2 to 3 years and to evergreen the balance sheet so that we are not consistently and constantly going back to the market to raise money. This is a sustainable model in its own right. Thank you very much for your attention.
Thank you.
Well done. Got any questions, please, from the floor?
What has been your most successful investment to date and your worst?
Okay. So we put up our most successful. So Blue Prism is our most successful. So that is a £900,000 investment into, and that is 95 million that's gone back. That is by far our most successful one, with a linear behind it. Our worst is the other 50% in that portfolio that failed. And this is important to note, that within the venture portfolio, within our funds, and our investors expect, our investors got 5.5 times their money back, that over half of that portfolio will fail outright. It just will, if you're doing your job properly. If you carry on propping them along, you're not doing your job properly. So I don't mean to be flippant, but I'd say that the other half of the portfolio are the worst ones.
Just one more question. How do you affect the trade sales?
I'm sorry?
How do you affect the trade sales?
Yeah. How do we... Yeah.
So with scale, 86 employees, and a tremendous amount of experience, we have a track record and reputation for building valuable businesses and selling them. And we work with a number of corporate advisors that fit within those particular businesses. So there is a group of corporate advisors that help us with private equity businesses, which is very different to the deep technology businesses that we're going through. So we have that range. We also have James, wherever he is in here. So we have James who helps us with syndicate deals. So we have a lot of this expertise internally as well. And so it's a combination of internal expertise and accessing the intermediaries that are there.
Hi there. Just reflecting on current economic scenario, mainly on the Brexit, what are the micro and macro level risks that you see, knowing you would expect capital both from within the country and from abroad as well?
Yeah, I knew somebody was going to ask about Brexit. There are a number of answers to that. Okay, so the first one is actually go back 3 years when this was all kicking off. We actually sent a questionnaire out to all of our portfolio companies and asked them, in the event that this goes the way you're not expecting, and that it is a leave Europe, what's your, it was like top 3 fears, I think. What are your top 3 fears? And the number 1 fear was about skill access. Because these are businesses that are growing fast, they need to get skilled people into the businesses, and invariably they are from the UK and not from the UK, and invariably from Europe. And actually, I think that has been addressed in large part by 2 different prime ministers saying that that skill barrier will not be there. We will not block people who are needed in the country. So that's an important thing. The second one is really predicated. So Mercia wasn't born because of the risk of Brexit. Mercia was born from the reality that we have economic cycles. It just happens. So we have a portfolio which has modest capital needs. Most of our businesses can be satisfied with our own cash if we have to do that. And these are businesses that will grow with modest capital support as well. So that sort of modest capital needs, that portfolio balance across different sectors as well, and the ability to have confidence that we can access skill into those businesses comforts us. I think the final thing is to do with inflows of capital. The inflows of capital for our funds under management are domestic. So our investors are domestic in our funds, and that's really important too. So we're not then at the whim of whether an overseas institution has decided no longer to allocate capital to the UK. They are UK dedicated funds that are going into our funds in the first place.
Thank you. How much of your personal money have you got in this business?
I personally put everything into it. So Mercia is I'm lucky enough to be on my third business, and every bit of money, and my wife keeps telling me off for this, but every bit of money I make from one, I put into the other. So I own about 2.5–3% now of Mercia because we've been diluted through raising capital. The whole company, so management, employees, the board, owns approximately 23%. And I think that's really important. We are substantial shareholders collectively. The whole company, everybody in the company has share options, and most of employees have actually invested into Mercia and our equity holders as well.
Following on from that, Mark, how many institutions and retail? What's the split currently?
On the share register?
On the share register, yeah.
So about 150 shareholders in total, of which our retail investors represent approximately 8% of the share capital.
Okay, excellent. So we've got a question here.
What is the growth rate? I'm seeing statistics about that. How you're growing?
Because you're on the phone.
I mean, year on year, was the price growing?
Are you referring to the business performance or the share price?
Share
performance?
price.
So the share price, so our share price over the last 12 months is 9% down. Okay?
Year on year.
And
Well, that last 12 months.
last 12 months.
Oh,
Yeah, so last 12 months share price down 9%. For all of you that are in AIM, you'll know AIM 100 is down 23% and AIM all shares down 19%. So it's not great news, yeah, and our share price is down. So business performance strong, business momentum strong, share price disappointing.
Also, next question, if I may ask, Mark, is commercial partners, is that part of the criteria for choosing the companies that you invest in and take on board for the fund? They have to have commercial partners and be in profit?
So the answer to that depends on what allocation of capital we're talking about. So if it's the venture fund capital,
Yep.
it could be two people who've got a really interesting idea and nothing more than that.
Right.
Okay? Blue Prism was two people
Yeah.
with a really interesting idea and nothing more than that, and a conversation with Barclays. Okay? So if it's the private equity one, it's a profitable business.
Yep.
It's got a solid management team, and we think that, and maybe there's a generational change or there's a management change, there's second tier is going up to the first tier, and we think there's an operational enhancement opportunity where we can continue to grow that business. If it's a debt one, it's a profitable, I mean, this is Martin's domain, the debt.
Yeah, so these are relatively small SMEs, but they must be profitable and they must be generating cash.
And then if it's a balance sheet investment, what we're doing in the biggest challenge, and most of our balance sheet investments have come from the venture funds, the biggest challenge is get the business model to work, okay? Which sounds flippant, but that's the biggest challenge. As soon as that business model starts delivering, and you've got ARR, you've got revenue, recurring revenues coming through it, and you think, right, we've nailed this. This is now about putting capital in here to scale it. It comes across. Now, that might be because it's got a commercial partnership and it's helping it scale through. It might be not. VoxPop.me does not have a commercial partnership, but its revenue is scaling quickly, and that's why it came across. I mean, they'll do about 5–6 million this year, and will have over doubled in 12 months. So it's a business model delivery answer for the balance sheet.
You mentioned about the return on Blue Prism, about 95 times. Have you already reduced the holding, or are you still maintaining?
No. So it's important. So when we sell out of a business or when we sell out of a listed stock as in Blue Prism, it's not because we've lost faith in that. Is that we're here to make money. I mean, I'm not going to... Our single motive is to make money for our investors and make money for our shareholders. And what we did with Blue Prism is when there was a liquidity event, so we could do it without damaging the business, we sold. So we sold on IPO and we kept selling. And in March, I think March, April this year, we fully unwound. Yeah. So we're no longer a shareholder of Blue Prism. Yeah.
My final question is, what keeps you up at night?
What keeps me up at night?
Yeah.
Well, I think I heard from the previous guest speaker about not talking about your favourite children. You know, we've got on our balance sheet 21 children. We've got 400 children. You know, across our portfolio are 400 children who, actually, if they all succeed, that's great. And so they keep us up at night, all 400 of them.
Okay. Thank you, Martin. Thank you, Mark.
Thank you. Thank you.